Okay, we'll start the ones for chapter 11, discussion questions. Textbook starts on 506. Let's discuss number 1, 3, 7, 10, 12, and 14. So if you want to get going on number 1, all right, let's talk about this one. Why are large corporations often described as publicly owned?
They're company that has big stock, so they have a board of directors, and so when that board of directors they're using this people who the shareholders.
Yep.
Pretty much, are funding what they're
Right. Yeah, and so the shareholders, key word is publicly owned. So how do shareholders in publicly owned, like what are those?
Anybody can be a shareholder.
Yeah, anyone. Yeah, the general public, anyone can be a shareholder. And so, have you guys heard of the New York Stock Exchange and Nasdaq, S&P 500? Those are companies, publicly traded companies. That you and I can go and buy stock. And so those companies that are listed there have thousands or millions of shareholders from the general public. Okay, yep. That's pretty much what they wanted you to understand on that question. So, what's next? What's the next one I have starred? 3. Okay, let's talk 3. It says distinguish between paid-in capital and retained earnings of a corporation. Why is such a distinction useful? So the question I'd be asking yourself when you're reading this text, the text is like, what does paid-in capital represent, and what does retained earnings represent, and try to answer that question. It's a pretty easy to find. Anyone find what page number? 490.
Oh, okay.
Okay, anyone want to give a shot what paid-in capital represents?
Contribution from the investor.
Yep, contribution. That is a good word to use. Yep. Yeah, and so I mean, think of
In exchange for stock.
right in exchange for stock. So, like another way to say contribution for a corporation would be, in exchange for a stock, you contributed money in exchange for a stock certificate and ownership in a company. Now, if your company is organized as a partnership or like a sole proprietor, that word is I still like that word, contribution. The only difference is you're not getting a stock certificate. You're a partnership. You have equity contributions. So, okay, yeah. Retained earnings. Anyone want to give that a shot? What that represents?
Retained profit.
Yeah, I like the word profit. Yep. So it's do you see the difference? Paid-in capital, it's just what the investor contributed with their own money. Retained earnings, exactly that. It's just accumulating the balances of prior year profits. So hopefully your retained earnings is positive because that means that you've had profitable years. Why would an investor or someone reading the balance sheet want to see retained earnings and additional paid-in capital separated out?
So that for their long-term investments, they can make money.
For the long, they can make what?
More money on the investments that they put in, because the longer they put in, the more or the gain that they get from the
Yeah,
they put in.
yeah, yeah. I like the word that you use for investment, so you can see what is separated out for investment. Because you're wanting to make money for that investor. I think that's the thought you're having, which is correct. Is you want to know first off how much money people have invested, so you can know how to get them a good return. But then, why would retained earnings be useful?
For company profitable.
Yeah,
Yeah, it shows how good they are at running the company.
right. Yeah, because if it was just lumped into just one line item, like if retained earnings and paid-in capital was just on one line on the balance sheet, then yeah, you don't know if that business has been profitable in the prior years, because you probably would see a current year income statement, so you might get a picture of what happened for that current year income statement. But yeah, if it's just on one line on the balance sheet, you don't. That's like one of the first questions you should be asking. Is this a profitable business? And the way you would see is you actually wouldn't go to the income statement. You would see even through retained earnings. That'd just be a high level way to see if they made profit in the prior years. And then also another reason why is typically dividends are paid out of retained earnings, not the additional paid-in capital. So that's another key thing to remember is dividends paid out of retained earnings, not additional paid-in capital. Yep, I think that's it for that question. What's next? Number 7. State the balance sheet or income statement classification of each of the following accounts. Okay. Does this talk about on a certain page? Like, there's nothing on the page that this talks about. It's this one that we should just talk through. Is this the question that we're accumulating certain information from prior,
I think.
like,
Yeah.
one of those questions that like should be building upon
Mhm.
prior knowledge? Okay, that's what I thought. So I think we should probably just talk this one through. So the first one is what, cash?
That's an asset.
Yep, correct.
Oh, but it says received from the issuance of capital stock.
Mhm.
So,
State balance sheet or income statement. So first it's wanting, okay, so it's first wanting to identify, hey, is this going to appear on the balance sheet or income statement, and then what account classification. You're right, cash. Didn't you say asset?
yes,
Yes,
but then if it's from capital stock, isn't that equity? No?
that is. But yes, you're right. But the thing is, it's asking about cash uh, from the issuance of. It's when you think of what account the cash is.
Okay.
It gave the info.
It's like stockholders' equity is like one of the,
Yeah, but the account in question is cash, not what's in parentheses. So it's asking, yeah. So yeah. What is the next one?
organization
Organization.
costs. So that would, liability.
First ask what account, what would it go on a balance sheet or income statement? First ask that question. Income statement, correct. So if it goes on an income statement, it'll either be a revenue or expense, because those are what goes on the income statement. So expense, yeah. Is the next one preferred stock?
Yes.
Okay, what financial statement does that appear on?
Balance sheet.
Balance sheet, correct.
Mm.
And then what section of the balance sheet? Equity, correct. So some, like since we're talking corporations here, it would be stockholder equity. Equity is still the answer though. Retained earnings, is that a balance sheet or income statement? Correct. And what section of the balance sheet? Equity, correct. Additional paid in capital, what financial statement? Yep. And what section? Equity, yep. Income tax payable, balance sheet or income statement? Yeah, keyword payable. And then what section? Correct. All right. Let's do number 12. What is treasury stock? Why do corporations purchase their own shares, and is treasury stock an asset? How should it be reported in the balance sheet? All right, you guys know what page to look on? 499? Okay, yeah, so there are some journal entries I think would be helpful to understanding this. Treasury stock. So anyone want to give a shot of what's going on with, like, what is treasury stock? Anybody?
Stock the company is bought back.
Yeah, I love that answer. Yeah. Okay, so if you're buying back stock, what do you think the journal entry is to buy back stock?
Debit the stock.
Yep.
Credit the cash.
Yeah. And so the account that you would probably use is treasury stock. And so treasury stock is what type of account? Where does that appear? Balance sheet or income statement? Yep. And then what section? Equity. Equity. Correct. Yeah. So in this case, if you you already said credit cash.
Yep.
Yep. So if you bought $100,000 worth of stock back, you'd credit cash, and then you would debit treasury stock, $10,000 or whatever. Okay. So why is it asking us why we would buy back stock?
Explain
Yeah.
the effects it would have on the balance sheet.
Yeah, that, and then, okay, the second question, why do corporations purchase their own shares? So, why would a company want to buy back shares that they've already issued? I think the textbook will probably talk about it. I'll just kind of, does any thoughts come to mind? If you,
Employee offering.
yeah, yeah. So if you have an employee-owned company, you want to provide stock as compensation to them. Well, you have to have enough stock that's available to issue to them. So that's one reason.
They could just offer more stock, right? But then it drives down the stock price.
Yeah, so you're going on to the next main point is you want to, one of the main multiples that investors look at is earnings per share. And so anybody want to give a shot of what that calculation would be? Earnings per share. How would you calculate that? EPS. Earning per share.
You have $1 million worth of stock, you have 10 stockholders compared to 1 million stockholders.
Well, okay. Well, you got one part of the formula right. You like let's just say you've issued $1 million of stock. Okay, so you have let's call this uh, yeah, it's just the stockholders' equity. That's where that would be reported. Stockholder equity is one part of the formula. What do you think the other? So earnings per share that's in a ratio. So your total earnings.
Outstanding shares.
Yep. Yeah. So it would be earnings, like profit.
Yeah.
Be your profit divided by stockholder equity, and then that equals earnings per share. Okay. So if you if would you want to increase or decrease stockholder equity to drive up this ratio? It's like it's a math problem. Exactly. Yeah. So by decreasing stockholder equity, you'd boost up that ratio, and that's a ratio that investors are looking at. And so that's one reason why sometimes companies buy back their share is to boost up that ratio. Okay. Let's move on to number 14. It says the basic accounting equation for a corporation is assets equal liabilities plus stockholder equity. Stockholder equity is further divided into two categories, paid-in capital, retained earnings. What are the major transactions and other financial activities that impact amount of paid-in capital of a corporation? Identify for each major type of transaction or activity whether it increases or decreases the amount of paid-in capital. All right. Let me know if you find something in the book or if this is a question that is making you just think on prior knowledge that you currently have. Is anyone finding anything in the text? think by your silence, maybe not. Okay.
There is a section about paid-in capital.
What page is that?
490. I haven't found this section about like, examples for it.
So the issuance of stock, but then I don't really. It's just talking about whether the company buys back stock or people are buying stock.
Yeah, it's one you to just analyze what are the different activities that would make that additional paid capital increase or decrease. Okay.
And how is the price of the stock change? That's
But
so like if it goes down 31 cents a share and they gave out $1 million worth of stock.
Yeah, we should have discussed number 10. Let's discuss it. I would rather do that. That's why I started that.
Oh, okay.
I skipped over and thought you asked that question.
That yeah.
We
that's-
will, we'll ask that question. We'll analyze that question. I think that will help you. So I think that if you read page 499, 500, it's still not treasury stock, but you'll get some of the answers. This is an answer that this discussion, like it's wanting you to put together like what you know about additional paid-in capital, applied with the accounting formula and journal entries from prior chapters, and it's more of an analytical type question. Okay, so let me just list off the transaction activities, and then we'll just talk about them. Okay, so what we're talking about is what's going to affect the additional paid-in capital. That's part of the equity part of the balance sheet. First, a sale of capital stock. Would that increase or decrease additional paid-in capital? Increase, yeah. Don't let the word sell, it's not confuse you. So yeah, that journal, it would increase. You would debit cash and credit stockholder for equity or additional paid-in capital. APIC, that's additional paid-in capital. Okay, purchase of treasury stock. Would that increase or decrease additional paid-in capital? Decrease, correct. Anyone want to give a shot at what that journal entry would be? You would debit.
Treasury stock?
Yeah, that would work. Yeah, treasury stock, but and credit cash. So treasury stock, like sometime, yeah, like that's in the section on the balance sheet of additional paid-in capital. Yeah. Sale of treasury stock. Would that increase or decrease additional paid-in capital? Yep. Because the journal entry for that is you debit cash and then credit the treasury stock. Here's a trick question. Stock split. None. Stock split increases the number of shares of the stock, lowers the market price of the stock, but does not affect the total amount of paid in capital. Does that statement make sense? I'll be more than happy to talk more about that if someone's not grasping.
What is a stock split?
Yeah, so
Don't they make it so more people can afford it?
well, that might be one reason why. So yeah, if you do a stock split, yeah, it would probably decrease the price of that stock for future
Yeah.
purchasers. But that doesn't change anything from what's happened in the past for what's been issued in the past. So the value that a person has as a stockholder, it's not going to change. The only difference is they just own more shares. But like she was talking about, it's just prices, a lower price going forward.
So like 2-to-1
Yeah,
split
well,
or
yeah, you
3-to-1.
might have heard, yeah,
Yeah, because otherwise shares could be like $3 a
Yeah.
share, and they
Yeah.
want it usually like under $100.
So say you have 300 shares and it's a 3-to-1 split, you have 900 shares, right?
Yeah.
And they just provide that amount that you had, that price.
Yeah. Make sense now?
Yeah.
Perfect. I overlooked number 10 in the textbook. I think we should go through that one. Number 10 says in the stock market crash of October 19th, 1987, the market price of IBM's capital stock fell by over $31 per share. Explain the effects, if any, of this decline in the share price on the IBM's balance sheet. This is one I don't know if you need to try to look up anything. We need to probably just talk this one through. Yeah, so from your knowledge so far of equity and stock issuing stock and buying back stock, what would you say to this? The main thing you need to ask is there anything that's going to affect the balance sheet? Is there any journal entries that have to be reported because of this information? And it's a simple yes or no.
I would think yes.
But then try to explain why. Like, yes, why, and where's your,
Because
Yeah.
if you issued $1 million worth of stock and it went down $31 per share, then it would be $31
that's
less
the
per
value.
share.
But the question I would then have for you, did those people who own those stocks sell their stock?
No.
So yeah,
But yeah, that it's like,
Yeah.
so it's not worth less to the company?
it is. Like,
They just haven't sold.
it just, in the data given, it just said that the only data that's given is the stock just went down. It didn't mention
The
anything
company
about
doesn't realize it until they
till
sell
they
it.
sell it. That's
Okay.
the key thing you gotta know is you gotta be looking for, did they sell the stock? Or, well, even be careful of that. Like, did the stockholders sell their stock? You know, from the company's point of view, did they, it's not like they bought back the stock, but I'm having trouble explaining from the company's point of view. When I say sell stock, it's from the stockholder's point of view. And that is, yeah, what would that journal entry be? So, what I'm trying to explain is a stockholder sells their stock. So, what would that journal entry be?
So that's them selling back their stock to the company.
Yeah,
The cash revolving there. Just increase in cash and decrease in their stock.
yeah. Yeah, let's think that through. So you know they,
So without-
yeah, so then who's getting the cash? The stockholder is. Yeah, so from the company's point of view, the company is paying stock. I'm sorry, paying cash. So if you're paying cash, then would you debit or credit cash? Correct. So you'd credit cash, and then you would debit stockholder equity. Let's see. Does that make sense? Is that
Yes.
is that what you're asking me earlier?
Mhm. But then probably like in real time, they would probably turn around and sell it to somebody else right away, the shares. But
Like in real time,
Somebody else would buy the stock that they just sold back.
but then they would be buying
at a lower price. Yeah. So then, yeah. I mean, if you added that information, then a stockholder buys stock at lower price. So then cash you would debit for, let's just say it would be a lower amount.
Mhm.
Let's just say 5,000 instead of 10, and then stockholder equity you would credit. The net result of cash is a net credit of 5,000. So you're like down $5,000 of cash and down 5,000 of equity now after those two events happened. Yeah. That was what you were asking earlier, right?
Yeah.
Okay. See how we're doing on time. We're a little behind, but I think that these discussions are important. I think this is where you're going to be able to grasp. So I think we should go to chapter 13 and keep plugging away. And then let me identify which one we should do here. Yes, do number 1. Do number 2. Number 3. I'll catch you up. Sorry, I'll follow you. Yeah, let me make this comment. I would say, given the fact of your group assignment, it might serve you well to study the answers to these questions that I'm going to post. Because I think that this chapter and understanding these discussion points would help give you a lot of good content to put in your report you have to write. Because the project is a lot about cash flow. So there's no way we could talk all the details in the next hour and a half. So I would encourage you to study this chapter for that group to sign.
So it's a forward to a group,
I'm sorry?
group assignment, it's a forward to a group.
I'm sorry, what did you say?
He said group assignments, it's forward to the group.
Yeah.
Yeah, you weren't in here.
I thought you were saying forward to the
Yeah,
goal.
sorry. I have to do
Yes.
Yeah, I mean, I think it's whatever you guys want to do. This is the smallest class I have. Typically, the groups are 3 to 4 people open, so I don't care. Y'all can usually one group if that's what you want. All right, I started at 1, 2, 3, 8, and 15, but like I said, I think that like all of these questions can give you some really good content. Sorry, I guess I didn't give you enough time to read through this. Let's go ahead and talk about it. Yeah, briefly state the purposes of a statement of cash flow.
What page was that one? Thank you.
Yeah, this is just a simple definition. I'm sure that there's probably just a simple definition in the textbook. It should say something like the primary purpose of a statement of cash flow. Provide information about the cash receipts and cash payments of a business. And related purpose is to provide information about investing and financing activities of the business. Is that what you guys were reading? Okay. All right, let's move on. Number 2, does a statement of cash flows or income statement best measure profitability of a financially sound business? Explain. I think you should probably already know the answer by now to this, actually without reading. So, what would you say?
I would say no, because it's like a shorter term
Yeah.
thing.
Is it yes or no question?
Oh,
I
cash
see.
flows or income statement.
Oh, so that it's wanting you to pick. Would you use a cash flow statement or an income statement to measure a business's profit?
Yeah, the income.
Yeah. Don't overthink it. The income statement's going to give you the best measure for profit. So then the statement of cash flow. A key word for like why you would want to study cash flow statement is solvency. Have you guys? Okay, so let's define solvency. It's my best stab at it from memory is it's like is the business solvent? Do they have enough cash to pay off their obligations, and also do they have extra cash, because they made a lot of profit, or is all their profit not easily converted into cash? And so, solvency is the ability to mainly just to pay off their obligations, and also to remain solvent. Let's see if there's a slide in here on solvency to clarify any misinterpretations I just gave you. Oh yeah, it's not in the slides. Is there a definition in the textbook? I don't know if there is or not. I think that's a good.
Solvency.
Huh?
Solvency.
Uh-huh. I think that's a good one.
Insolvency.
What is insolvency say?
Heading towards insolvency. Yeah, they have solvency. Cash flow, liquid statement, cash flow from equity, insolvency. Within,
Where is that? What page?
434.
Yeah, I think I was pretty close. I mean, the definition I looked up is ability to pay all just debts. So, like, solvency is, think of another word to think of is liquid, cash. So, solvency and cash go together. So, your cash flow statement should give an indication of whether you're able to pay off, those financing activities or investing activities with the cash. Or like when we're about to study like what goes in the investing activity section of the cash flow, like equipment or other assets you have to buy, are you finding yourself having to take out a loan for to finance those pieces of equipment or assets? Or are you able to finance those through the cash that you generate through profit? A cash flow statement should give you an indication of how you're able to pay for those assets, whether you took a loan or paid out of cash. And so, solvency, yes, you can tell from a cash flow statement whether a company is going downhill from a cash standpoint from the cash flow statement. And the tricky thing is you might even see profit from their income statement that might measure. So because the income statement is the measure of profitability, but then you might then review their cash flow statement and say, hey, this company might be making profit, but they don't got cash. They're making all their profit because they're taking out all these loans, and so they might be too much. You might find out by analyzing the cash flow statement and the balance sheet that they might have profit, but it's like they got a debt problem. They got an obligation problem that they might not have the ability to pay all just debts, and they might be on the road to insolvency. All right. I don't know how we got on that, but where are we? Number 3. Okay, give 2 examples of cash receipts and 2 examples of cash payments that fit into each of the following classifications: operating activities, investing activities, and financing activities. Yeah, at this point, I think it would probably serve you well to see an example of a cash flow statement. Is there one?
Yeah, there's one
Yeah,
on that,
right.
567.
Oh, I was looking at 582. There's probably another one.
We can look at both of those. 567?
Yeah.
Okay. Yeah, I like that format. Yeah.
Examples of cash receipts and cash payments.
Yeah, but then also it's one unit separating those three different activities.
Some cash receipts.
Yeah, so it is giving you some examples here. Okay. Yeah. Yeah, that exhibit 13.1. You should be able to really discuss this question. So, if we use that exhibit, what are some examples of cash receipts found in the operating activity section?
Cash received from customers,
Yep,
interest and dividends received.
yep. And then what are some payments?
First payment, income taxes paid.
Yep, those are a couple. Yep. Move to the investing activity. What are receipts for investing activities? Some examples.
Proceeds from sales of marketable securities.
Yeah, so that another term for marketable securities is investments. So you sell some investments that you have. Okay, and then what other example?
Collections on loans.
Yep. One other example, does it have one sales of plant assets? Okay. What are some payments for investing activity?
It's a settle short-term debt.
Wait a sec. Say that again?
There's payment to settle short-term debt. The financing activity.
Oh,
That's
we're in the investing still. Sorry about that. That's correct for the financing activity section.
Purchases of marketable securities
Yep.
and purchase of plant assets.
Uh-huh. And
loans made to borrowers.
lending cash. Yeah, another way to say that is you're lending cash to loans to borrower or pay to a borrower. Wait, what did you say? It was loan
Loans made to borrowers.
made. Yeah, loans made to borrow. Okay, so moving to finance activities, what are examples of receipts?
Proceeds from short-term borrowing.
Yeah, so proceeds from short-term or long-term borrowing.
Proceeds from issuing bonds payable.
Uh,
Proceeds from issuing capital stock.
uh-huh. And then sale of treasury stock as well. What are some payments found in the financing activity section?
Paying dividends.
Yep.
Short-term debt. So
Oh,
Yeah. Repayment of debt. Yeah, the repayment of debt. Yeah. And then purchase of treasury stock. Yes, I know that you'll have to identify where these different. This is just a matter of classifying. Classifying, these different activities. Are you starting to understand like why you would group these in these different sections? Yeah, one way to think of it is the operating activities. Think of these are what the cash receipts and cash payments from just normal operations of your business. Okay. One way to say the investing activity, that should be, it's going to give you a picture of money you received from. It's basically it's giving you a picture of what assets you had to invest in to perform your business. And so think of assets you had to purchase. This is giving you a picture of your receipts and payments for your assets. And financing activities, one way to say that is, how are you financing this business? And so it should give you a picture of the receipts and payments affecting the financing activities of the business. And so it's just categorizing these different ways to categorize and think of these different areas of cash flow in a particular business. Okay, let's move on. Number 8, briefly explain the difference between the direct and indirect methods of computing net cash flows from operating activities. Which method results in higher net cash flows? Well, I'll go ahead and answer the last question. It's a trick question. It should be the same. So don't let that trick you. So the slides I have in week 2 have some good slides also, in addition to the textbook. If you remember anything, here's the trick to understanding. Indirect versus direct. Indirect always starts with net income at the top. So then you would ask, the direct method, here it is right here. Direct method provides readers with specific positive cash flows, specific negative cash flows. This indirect method begins with net income from the income statement and details changes in relevant balance sheet account, and adjust the net income amount to reflect the cash flow from operating activities. What I would recommend doing is just meditate on an indirect cash flow, and just see if you're starting with net income, you're either adding back or subtracting out non-cash items that were in the income statement to then calculate the ending cash balance. So, this is the indirect method. You start with net income, so you're adding back depreciation expense. A decrease in accrued interest receivable, increase in accounts payable, increase accrued interest liability, and then you're subtracting out. See the less your increase in accounts receivable, increase in inventory, increase in prepaid expenses, decrease in accrued operating expenses, operating expense payable, decrease in accrued income tax payable, and non-operating gain on sale of plant asset. Okay.
It's asking which method results in the higher net cash flow.
It would be the same. Yeah.
Oh,
It's going to be the same. It's just you're analyzing it in two different ways.
Oh,
This direct method, it's just a simpler method. You're just seeing the basic inflows and outflows. So cash received from customer, interest, dividend received, and cash paid, interest paid, income tax paid, and then the net cash provided. Looks like this is just detailing out the operating active section of this particular slide. But yeah, the net cash is going to be the same. On this indirect method, you're starting with net income, and then if you notice, oh, sorry. I'm so sorry. Right there. If you notice that everything except for this non-operating gain on sale of plant assets, you notice that these are, and then also this non-operating loss, everything else is a balance. It's just the change in the balance sheet item from the last time you prepared a cash flow statement. So if it was last month, you're just calculating the change in these different asset accounts, or depreciation expense, or these non-cash items from the income statement. So depreciation expense, you didn't pay cash for depreciation expense. You didn't. That was an adjusting journal entry you did at the end of the month, right? These decrease in interest receivable, in accrued interest receivable. That's not reflected in this net income amount. Okay, but but the thing is you received cash for that. So this is a balance sheet. So the journal entry for decrease in accrued interest receivable, like the net result, it didn't affect the income statement, but you still received money for that receivable. It's just there's just a difference with money. So what that's saying is you accrued that interest income, or the increase in accounts payable, that's saying that you accrued more expenses on account than you paid to your vendors. You're starting to click a little bit on the indirect. This is kind of confusing.
Page 581, this is really good. Thing for that, for really indirect methods, it pretty much said everything that needs to be included.
oh, okay. That's what
Yeah.
I was gonna ask if, like, do these always stay in the ad and these always stay in the deduct?
Yeah, but yes, that's one way to look at it. But the thing is when you're preparing a cash flow statement, you would start with, well, if you're doing it the indirect method, that's what I'm saying. You always start with net income, okay?
Mhm.
And then you're just either thinking non-cash items that hit an income statement. Do you know? So that's a key term that I'm using. Do y'all understand what I mean by when I say non-cash income or expense items on the income statement? Am I talking too technical? You know what so like obviously an example, like right here, if you take this example here, page 581, 13.7, those non-cash items is depreciation, non-operating losses, and the non-operating gain.
Read nothing.
Putting the ladder in
He's
front of
putting a
the door.
Bible out. He's climbing up the ladder.
We were complaining about the HVAC.
Really?
Those getting higher.
The non-operating gain or loss might be a confusing one. I don't know if we've gone over that much, but that is a gain or a loss that you reported like in other income section of the income statement. It didn't involve you receiving cash, but like one of the examples I think of is if you have an investment in like let's say your company has investments in stock, like let's say a mutual fund. Like a mutual fund, it either has unrealized losses or gains throughout the month, but you hadn't cashed out of the mutual fund. You hadn't sold that stock. You're just reporting the unrealized portion of that gain or loss. No cash has been involved. You hadn't sold it yet, but you're still reporting that gain or loss, non-operating loss or non-operating gain. But then these other ones, so yeah, I guess going back, when I say non-cash items, does that make sense now? Okay. So yeah, indirect method, once again, you're starting with net income. You're either adding or subtracting out non-cash income statement items, or you are adding or subtracting the difference of balance sheet item. So for example, if what was that example here? Or, like, all these other ones are balance sheet items. So basically, yes, this is a good way to think of it, but like if you're preparing a cash flow statement, you first go, you look at the non-cash items in the income statement, but then you're just taking, that's why you're preparing a cash flow statement after you've already prepared a balance sheet and an income statement, right? You don't prepare a cash flow statement before those statements because you don't have the data yet. But if you are doing the cash flow by indirect method, net income, and then you're taking your balance sheet and you're seeing how those different assets and liabilities, did they increase or decrease from the prior month? So basically you're going to need to have last month's balance sheet to calculate that. Okay, you know what I'm trying to say? So if it increased, so like if an asset increased, right here, well, I guess, let's just, are y'all still on that page 581? Okay. If accounts receivable decreased from prior month, that is an indication, what happened? Like, why would accounts receivable decrease? You're thinking of cash. Because you receive cash, right? So but the thing is if it decreased from prior month, why are you adding that back to net income? Well, you
So it's cash received.
it was cash received. That's one way to think of it. Yeah. Another way to think of it is this. That's a simple way to look at it, just to kind of know where to even categorize it. Another way to think of it is I received cash on sales I earned in prior months. All right. Does that statement make sense?
What if there was an increase in interest receivable? Would it go down to the less category then?
Yeah, if you look at it, there's like opposites of each one. So are you talking about the decrease in the accrued interest receivable?
Yeah.
On the bottom for the less, if it's an increase in
It has it in here. This diagram here has that increase. I think it. What did you say? Interest
So it
receivable.
would be an increase in accrued interest receivable.
Yeah. So an increase in the key word is receivable, whether it had interest or not. Like an increase in receivable.
Okay.
You would deduct that
Yeah.
from the net income for the cash flow.
Okay.
Because you have, well, to simply put it, you have not received the cash yet. However, but then to go further in understanding, you've reported that interest income in net income. So right now, net income has that interest income reported as income. However, you have not received the cash. Therefore, you need to deduct it out for the cash flow statement. So that's an example right there of where the income statement would have a higher. That's why you're analyzing both the income statement and cash flow, because I hate to just keep beating the same point, but that's why an income statement measures profitability. Cash flow is going to give you a picture of your cash position. So yeah, I would definitely. I think that is on page 581 that chart where it has the examples of add and deduct for the indirect method. That's definitely one that if you're not understanding those how those affect the indirect method, then that's when I would be just asking someone to help clarify, to help understand, why you're not, why you're not grasping it. So definitely study that one. We gotta move on though. Right now.
That was the last one that started. Or wait, no.
Is there one more? 15? Okay, 15. Explain why speeding up the collection of accounts receivable provides only a one-time increase in cash receipts.
Are they saying like instead of getting a smaller portion for 5 months, you just get one big portion in 1
Yeah,
month?
that's one. Yeah, that's one way to say it. Yeah, the way they phrased it is speeding up the collection of accounts receivable does not increase the total amount you're going to collect. Rather, it merely shifts the collection to an earlier time period. So, I believe that supports that statement you just said. So the reason why I had that starred is in my understanding how that analysis works might give you some good content to put in a writing or in one of your papers you might in the group project, or I think you might have to you might have to analyze or write about a cash flow statement, because what we're building upon is like this accounting cycle from reporting these journal entries to finally creating an income statement, a balance sheet. After those are created, you can then create a statement of retained earnings and then a cash flow statement. And so where we're at now in this class is now being able to interpret those financial statements and like be able to analyze a business to see their to help make decisions on the different activities they have going on, whether it's the investing activities, the operating activities, or financing activities of the business. Okay, 9 o'clock. Let's take a quick break and then do like 5 minutes, and then after that, I'm going to kind of speed through an example to help out on this case study called the pizza, I think it's frozen pizza case study that's due next week. And then I think after that, I'm going to go through a couple of tips for the quiz. And then I'll let you guys I can speed through like the PowerPoints, or if y'all have I don't know, we can decide whether you want to do the PowerPoints, because y'all can always read those week 3 PowerPoints too, or if you have Q&A as well. So during your break, kind of think whether you would want, think through whether you'd want to ask some questions or go through the PowerPoint. So, all right, 5-minute break and then we'll be back.
So